Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Axel Merk. He is the president and CIO of Merk Investments. He's a manager of the Merk Funds, which he founded in 1994. And he is really quite an astute commentator and observer of macroeconomic trends and events, and also an innovator in various markets. The latest product he put out there that is really quite unique is the Merk Gold Trust ETF, and it's unique in the sense that you can buy it as an ETF. It is an ETF. You can buy it, and then you can actually have gold, take possession of the physical gold that underlies your ETF, and the symbol is OUNZ, I believe, is the symbol for that Merk Gold Trust. Thank you for joining me again, Axel. It's good to talk to you again.
Great to be with you.
Always good to get your insights, especially, it's not too many people I know who are privy to meeting the makers and shakers of this world, and you were just at a central bank conference, you told me, at Stanford. Anything you could tell us about that?
Oh, sure, yes. Well, the Stanford conference organized by the Hoover Institute, John Taylor, after whom the Taylor Rule is named, invited me. And a couple of interesting pieces there. One of them was Mr. Walsh, who was a governor during the 2008 crisis, saying that people are just reading statements during the FOMC meeting, that there isn't really any debate. You need to have committees. You need to have, you can't have just the chair decide on everything. Paul Tucker of the Bank of England, the former deputy governor there, chimed in on that and was bragging about how great they do at the Bank of England. The most noteworthy comment, I thought, came maybe from Charlie Plaza. He didn't get much coverage on that. What he said is that we should go back to basics on central banking. Now, clearly, in our audience, maybe we should get rid of them entirely. But what he said is that let the Fed just have a inflation target, nothing else. Mm-hmm. And what he means with that is when emergency liquidity is provided, the Fed shouldn't do that. The Treasury should authorize it. The Fed can then provide the money, maybe short term, but if that money sticks around at the Fed, it should be swapped with Treasuries. So basically the Fed gets out of all the politics, doesn't buy anything other than Treasuries, and that's how they can try to get away with the policy. So I thought that was one of the more interesting notes.
Well, that certainly was what central bankers did for the most part until recent years. Was if they bought anything at all, it was Treasuries, right?
Oh, of course, yes, but they do provide liquidity. He said, take it a step further. Even emergency liquidity, no, have the Treasury make that decision. And the key difference is that those are elected politicians, and it's fiscal policy, because the more support you provide, the more you're drawn into politics, the more havoc it creates, and the more it distorts the markets. And I mean, we've been complaining about that for years, obviously, but he says the way to fix it is not by piling more responsibility onto the Fed with financial stability. He added what the heck that means, whatever that may mean, and then all these other things. So let's just take it back. Let's dial it back. And I thought that was one of the more sensible comments that were made.
Mm-hmm. Well, thought comes to me, Axel, is why in the world do you need debate? We know what the truth is. All you have to do is print more money. It says no reason to debate it, right? I mean, just go out and asset purchase till to infinity. I mean, that seems to be the posture of both Bernanke and Janet Yellen. I mean, notwithstanding their rhetoric, it seems to be what they're up to always.
Well, and ultimately, of course, I've always argued that you can get away with a pretty bad central bank if you have good fiscal policy. But if you have bad fiscal policy, the best central bank won't help you. Ultimately, the hostage of the government, and obviously, all these issues are as old as central banking. And by the way, multiple speakers, including John Williams, the San Francisco Fed president, said that, hey, during the gold standard, things weren't so bad. They worked pretty well. You were able to kind of take the government out of many of these things, but he did lament that, well, ultimately it broke down. Whenever there was a crisis, people got off the gold standard. And that's a fair point as well.
Well, that is certainly heresy from a central banker to talk like that, I would think. I would certainly think that, I mean, I'm wondering to what extent, we read a lot, I don't know your comments, I don't think you and I have talked about this too much, but to what extent are the Chinese shaping a dialogue with respect to monetary policy? The BRIC countries, as it were. We're reading more and more things about the BRICS, and especially China, and to an extent Russia, but certainly India as well, continue to import huge amounts of gold. What are your thoughts on that? Are we heading into some sort of a competition for the petrodollar against say, a petro-gold system?
In many ways it does, but I don't think it's done in as overtly a way as the gold community discusses it, meaning that clearly gold, precious metals, wealth has been shifting eastward. But the question is there some quote-unquote conspiracy where people say, oh, we got to pile up the gold and take it away from the Americans or the Europeans or whoever might have it? I don't think so. It just happens as a result of wealth shifting. If you need money, you liquidate what you got. And those are any assets, and you sell your stuff out. And the folks who have assets, they buy it. And so sometimes they buy treasuries, or sometimes they buy gold. And so as such, yes, the status of the reserve currency is gradually being diminished, but I always compare it a little bit to a frog in a boiling pot. By the time that it has happened, it's going to be too late. And sure, we can warn about it, but it's just a process, a grinding process with ups and downs. And at the end of the day, yes, the dollar won't be the reserve currency anymore. And yes, the renminbi will be more important. And yes, the Chinese are going to have more gold.
Well, it certainly is historical. Whenever countries run into trouble, they get rid of their gold, and the gold really follows the wealth. So as wealth shifts from west to east, that certainly makes sense to me, Axel.
And it should. And it should. The only thing, of course, is that shouldn't happen is we shouldn't pursue policies where we have to give our wealth away. But if we do live beyond our means, the gold should move somewhere else. What has to change, we shouldn't put a block into that. What has to change is the policies we pursue at home so that we create wealth rather than give it away.
You know, before we get started, I want to ask you some things about some of these key markets, the dollar and the euro, and some more about gold and equities and so forth. But I want to ask you about the Merk Gold Trust. How is that going? And are people at all taking any possession of gold? Or are they just simply happy enough to have paper gold?
Well, sure. I mean, it's working quite nicely. We got a little over $60 million worth of gold in the trust. It's trading as it should, has historically traded with about a 1 cent spread. And most people buy it simply because they like to have the option of one day taking delivery. But we've had about a handful of people take delivery. And that process is working. It's tested. We have a patented process. And the idea is really that you can buy gold with the convenience of an ETF, but if you ever change your mind, you can take delivery. And what many people are not aware of is that taking delivery in itself is not a taxable event. So if you have appreciated shares of ounce, OUNZ is the symbol, then you can say, all right, give me the gold I already own through the ETF, and we ship it to you, and you retain the cost basis when you originally purchased the gold through the ETF.
Yeah. Okay, so you don't have to, obviously, until you sell the gold or trade it for something else, you don't have to report a tax event. Could you just very briefly review for our listeners what the process is if they want to exchange their ounce OUNZ for physical gold?
Well, sure. You come to our website, merkgold.com, and there's a calculator that tells investors how much gold their shares refer to. And if they want to take delivery, they fill in the application that's on there, and basically it says the type of gold they want to have. And note that we hold London bars in London, just like the other gold ETFs do, and you can take delivery of the London bars, except most individual investors don't like London bars. You can have those London bars exchanged into coins at the time you take delivery, and you can have any of the major coins. There are certain parameters, but most of the major coins are available. And then there's a fee that's associated with it. It refers approximately to the markup that you would pay for a coin corresponding to the spot price of gold, and you transfer the money to us. You file the application to us, and you transfer the shares to the trust. And then we release the gold and have that converted and sent. And the process takes about 10 days from start to finish. And so it's a fairly straightforward process. And then, by the way, the requirement is to take as little as 1 ounce, although it's not very economical to take only 1 ounce. We do have minimum fees, so starting at about 40 ounces, it's cost comparable to other ways of getting gold.
All right, very good. Well, let's get into the markets a little bit. The U.S. Treasury markets, we've seen the Bund, the German Bund, get hit pretty hard. It's rallied back a bit, so as has the 10-year U.S. Treasuries. What are your thoughts on the Treasury markets now?
Well, I mean, a couple of things. First of all, we've had a market where if you're a momentum trader, you have made money. And it doesn't matter whether you've been thinking, actually the less you've been thinking, the better it's been. And so people have been piling into things, and these trends work until they reverse. So people were piling into German bonds, and then at some point somebody decided to sell. And we had a fairly dramatic sell-off in bonds. Now, the day we're talking, bonds are actually up because the fears in the Eurozone are escalating again. But what it's symptomatic of what we have in all the markets, that volatility is compressed, complacency is rampant, and at some point, fear comes back into the market, and that's really when we think trouble is going to come to all the markets, because we don't have the liquidity that I think that many people think they are. It's one thing to buy securities, it's another one to sell them. And in the short term, we've had a huge, first for 9 months or so, everybody said the dollar is great, everything else is horrible, and the dollar was soaring. Then we had a big short squeeze, and the euro was coming back quite a bit. And in recent days, the dollar has strengthened again. Ultimately, the world is tones of grays. It's not that the U.S. is fantastic and Europe is absolutely horrible, and the opposite isn't true either. And so these markets are gyrating between extremes. Obviously, that gives opportunities to some, but mostly what it does, it scares away people. It dries up liquidity, and it's the only place that hasn't seen really much of the volatility is the equity market, and I think it's going to come there sooner rather than later.
You know, we were just talking to Michael Oliver a few minutes ago, and he is convinced that central bankers are not actually omnipotent, and that eventually, no matter what kind of anti-free market forces are attempted by central bankers, that the markets will ultimately prevail. I'm guessing that you probably agree with that general philosophy.
Well, of course. I mean, and we saw that you mentioned the bonds. I mean, the plunging as they did in just a few days the other day is a sign that central banks are just zipping from a straw from the ocean, and ultimately the market forces are stronger. But they do control the printing press. One has to be careful, because these are kind of some big boys you're fighting against. But at some point, yes. I mean, take Japan for example. In my view, Japan is pretty hopeless long term. The worst thing that can happen to them is economic growth. The reason I say that is because if you have economic growth, the bonds would sell off. It would make it, in my view anyway, impossible to finance the deficits. And so now central banks are going to fight it by buying bonds, by monetizing the debt. Well, something will give somewhere, and right now it's the currency again that's under pressure. But of course, when these big banks print billions and trillions, it's going to have ripple effects in all kinds of markets.
All right. Well, certainly, attached to the U.S. Treasury is the U.S. dollar. You were fairly bullish on, I think, on the euro to start this year. What's causing the dollar's relative strength? I mean, why are we seeing so much strength in the dollar? I guess it has to do with what's so-called easy monetary policies of Draghi, as opposed to supposedly tighter monetary policies by Janet Yellen, right?
Well, I mean, generally there are two major trends. Exactly, it's the interest rate differential, and then there's the potential fear of contagion with what's happening in Greece. And what I argued, and that's why everybody says I'm a euro bull, is that the Greek contagion is overrated. And the reason being is that very few financial institutions hold any Greek debt outside of Greece, and so Greece's problems are mostly problems for Greece, and then it's a political problem for major institutions like the IMF, the ECB, but those losses there will not cause a systemic breakdown. And then conversely, with regard to the interest rate differential, right now, again, we had a couple of days of good economic data in the U.S., so everybody thinks the U.S. is going to be tightening. Things aren't that great in the U.S., and things aren't that horrible in Europe. We have a cyclical recovery in Europe, and in the U.S., the recovery is not going quite according to plan. And we've had this talk about a rate hike forever. I'd like to remind people we're still at 0 to 25 basis points. And as we're going to raise rates, and I do think we will be raising rates, possibly as early as September, the Fed all but promises to be behind the curve. And the reason I say that is because the FOMC says in their statement that even if the economy goes back to normal and employment goes back to normal, the Fed will be having rates that are lower than otherwise normal, meaning real interest rates are going to continue to be 0 to negative. And so in that sort of environment, I don't know why the U.S. should be so far ahead of everybody else.
Well, then I would, with these negative interest rates, one would think that gold should be really on a tear. It should be rising very dramatically. Why do you think it's not?
Well, gold has held up very well in the light that the dollar has really been on a tear. So one has to put that into context. We've had gold was up 12 years in a row. Lots of speculators piled in on the upside. Then we had this major correction, and we probably overshot on the downside. And now everybody is waiting for what the next step is. If you have positive real interest rates, that would clearly be a competition to gold, because gold is a brick and doesn't pay any interest. Now, because there's this quote-unquote fear by some people that rates will go up, some people are reluctant to buy. And it's a herd mentality we see over and over again. As the Fed is going to raise rates, at some point people are going to point out, well, wait a second, they are behind the curve. But for now, because the next move is going to be higher, everything is going to be great, so people think. My view is that rates are low to negative now. I don't think we can afford to have positive interest rates in the U.S., in the Eurozone, or Japan anytime really for an extended period over the next decade, because we are just going to kick the can down the road. But in the meantime, yes, people are full that rates are going to be higher, and that's going to be competition to gold. And so you do with it what you want. I mean, you can just take it as a buying opportunity, or if you're in the camp that says, yep, real rates are going to go higher, then you might want to sell your gold. I'm not in that camp, though.
With respect to Greece, David Stockman article he wrote over the weekend, in which he's basically saying that, well, I'll just read here what he said. He says, the ECB is now on the hook for $138 billion of Greek liabilities, an amount that is equal to the remaining deposits in its entire banking system. Needless to say, when the impending Greek accident explodes into the front pages, there will be pandemonium at the ECB and in Brussels and capitals throughout the 19-nation Eurozone. That sounds like something that should be extremely bullish for gold, but maybe you just comment, is Stockman got the numbers right there, do you think? And to what extent might this be really a very bad thing for the euro?
I don't know whether he's right to the euro cent, but he's right in the order of magnitude. Let's not forget that the Bank of Israel has had a negative net worth for the past 20 years, and the world hasn't blown up. Whether the net worth of a central bank is negative or not is really a PR problem more than anything else. They're printing their fiat money, so it doesn't matter. Now, what's different about the ECB is that they have a contractual agreement that if they do have losses, that other member countries do pay that back into the ECB. But keep in mind, rules are there to be broken and to be twisted. And so they can say, hey, we haven't reached the maturity of these bonds, and therefore we don't have to recognize the losses yet. Look at the Swiss National Bank. We haven't had any losses yet that are realized. And so who knows what's going to happen in practice. Now, even if $130 billion were to be paid into the ECB, again, that's a political problem. That's not a financial stability problem, because the Eurozone as a whole can afford $130 billion. It looks pretty bad to have to pay that. And also keep in mind, the money that they've given has been collateral, and they've applied huge haircuts to certain things, so the actual losses are probably going to be much smaller. But yes, if Greece does default, and I'm not doubting that, the losses are going to be severe. I'm just arguing we're not going to have a blow-up financial system. Now, you're arguing, is it good for gold or not? Yes, I think it's good for gold. But again, we've had this looming Greek default for years now. And the market appears to have just gotten used to being in this zombie zone. I think we should just get it over with and see what's going to happen.
Well, certainly the status quo doesn't want to get it over with, and they're going to fight tooth and nail. The argument that some have that for higher rates, or for the Fed raising rates, if indeed you believe the Fed is in control rather than the markets, the idea is that the economy will be so strong. The economy is getting stronger, and therefore that's a good reason for rates to rise. And of course it is, but could there be other reasons? I mean, just loss of confidence, for example, in the monetary system, I would think, would be something that could send rates higher. What do you think was behind the recent the recent rise in the Bunds rates as well as U.S. Treasuries? What was behind that?
I think these rates are currently just driven by momentum traders that are piling in, and then if people want to go to for the exit, there isn't enough liquidity there. So that's why we're going to see volatility there. I don't think they reflect fundamentals really anywhere in the world. Rates should be much higher, but central banks have talked up the prices, lowered these rates, and they're just setting themselves up for a surprise down the road. And these are all just canaries in the coal mine, be it the Swiss National Bank earlier this year, the little Bund scare we've had, the taper tantrum, things. Once you start messing with asset prices on the scale that central banks have, you're just asking for trouble down the road, and it's difficult to say where exactly it's going to happen. The one thing I keep pointing out is, look at the equity markets. We haven't really seen a huge sell-off there, and that's really where I see is the biggest risk right now.
Well, that was certainly shake confidence, and in fact, it's sort of a new thing for central banks to be so concerned about stock prices. It never used to be that way. I suppose the reasoning is simply that you've got to keep people confident in the system. Is that what's behind this thing?
Well, it's because we needed to inflate asset prices. Remember, people were underwater in their homes, and the best thing to do is, of course, people downsize their houses to they can afford. That wasn't politically acceptable, and that's why asset prices were pushed higher. It's not working terribly well in lower income regions with home prices. It works in Palo Alto, where I live. It works on stock prices, but that's kind of the unintended consequences of trying to support housing. That's really where much of this came from, because in order to get an insolvent institution to be solvent again, if asset price inflation does it, then that's the tool that central banks use. And that's why if the tide turns and asset prices deflate, sure, there has a lot of healing has taken place, but it's still going to be a major headwind.
Thanks for joining me again. I'll look forward to having you back sometime soon.